Going to be getting the GDP numbers for the second quarter, and we understand it is 7.2, which is a little lower than the 7.4 that we got. The GDP is 7.1, and I think the GVA is coming in at 7.2. I know 7.1 is the GDP number, and that compares with our forecast or our poll of 7.4, so about 30 basis points lower. You must remember that the base is very favourable even now at 6.3, but the base was much more favourable in the first quarter. We had a base of 5.6. So you got a very good number in the first quarter. But this one at 7.4 is a bit of a, at 7.1 is a bit of a disappointment compared to the 8.2 in the first quarter. It's unfair to compare to the first quarter because it was a very, very favourable base. But the GVA has come in at 6.9. So 7.1 is the GDP and 6.9 is the GVA. Quite clearly a big disappointment in terms of it not even making to the 7% plus number, the GVA. So it's a little worrying because you have a favourable base even now at 6.3. It's not a very big base. So that's how the numbers stack up. For the first quarter, you got a number of 8.2. The GVA was 8%. What we now here have is the GVA 8% in the first quarter and 6.9 in the second quarter, despite a reasonably positive base that we had. I'll do one thing. We'll just get you all the trends. Let me get the first thoughts from our panel of experts. Upasana Bhardwaj, the senior economist at Kotak, is with us. Soumya Kanti Ghosh, the chief economic advisor of State Bank of India, and Mr. D.K. Joshi, the chief economist at CRISIL. Soumya, first thought, 6.9, disappointing, GVA?
No, I think it's a number which is far lower than market expectations and also our expectations. And I have not seen the numbers, but I think the agricultural sector could have come significantly lower than what we were expecting. And possibly the turbulence in the second half which started could have also possibly have dragged down the growth of the services sector.
Okay.
So my sense is that the number is a little is much lower than the market expectations, and the sense of an 7% or sub 7% growth rate which you are expecting in Q4 of this year now seems to may materialize actually sooner rather than Q4.
Okay. Well, actually we are getting some more numbers. I think it's 7.4% manufacturing. You'll have to wait a bit. We should be able to give you all the numbers. Trade, hotels and transport, as you can see in the flashes, coming in at 6.8%. The CNBC poll was more or less on those lines. Trade, hotels, transport coming in at 6.5%. And wait, we did have agriculture as well. Just give me a minute and we should be able to give that to you. Okay, 3.8% is the agriculture number. And that's finance, real estate and professional services coming in at 6.3. So finance coming in at 6.3. Agriculture came in at 3.8. And you had trade, hotels coming in at 6.3. Those are the three big numbers coming in. I think we had manufacturing also coming in at, I think, at 7.4. We are still juggling. Yeah, okay, that's the GDP growth. Well, those are the three numbers. My sense is manufacturing came in at 7.4. That flash will come up for you in just a minute. Mr. Joshi, your thoughts? 6.9, how does it compare with what you expected in terms of GVA?
Well, we had a GDP forecast of 7.4%, and I think this is definitely lower than that. And agriculture has been on trend. I think the underperformance in service, which started in the fourth quarter of last year, continues. And I think since service is a large part of the economy, I think that is what is dragging the growth down. I think it will also be interesting to see what's happening in construction, because construction had been very buoyant. So I haven't heard that number so far. But manufacturing at 7.4 is still, I think,
I'm a little better placed now, Mr. Joshi. So before I come to Upasana, let me read out all the numbers since we have them. Agriculture is 3.8% compared to 2.6 year ago. So low base and therefore 3.8%. Mining is a contraction of 2.4%. Manufacturing is decent, up 7.4 on a base base of 7.1, so not a bad showing. Electricity is 9.2, good performance over and above a 7.7% year ago. That's electricity, gas, water supply and other utilities. Construction is 7.8. That's the one you were looking for. 7.8 over a low base of 3.1 year ago quarter. Then trade hotels, I told you, 6.8 versus last quarter's year ago quarter, 8.5. Finance real estate, I told you, 6.3 versus the year ago number of 6.1%. And public administration coming in very good at 10.9% compared to 6.1. So that gives, all these were GVA numbers. And therefore, you have a value-added number of 6.9 compared to 6.1 year ago. So that was a fairly favorable base, and we still have 6.9. I'll stop over there and read the personal, the expenditure side in just a second. But Mr. Joshi, you were completing about construction.
Yeah, so I think construction is basically fired by government support and government spending. The worrying part is that the services sector, and I think here I see two factors which are pulling the services down. One is the banking sector, and which is a significant part of the financial sector, and second is a telecom in the trade. I think in the trade, hotel, transport segment. So I think these, unless the services sector turns around, I think the GDP growth will remain, I think it will remain around 7%.
Okay. Upasana, your thoughts, 6.9, and I think you have all the numbers. I might as well read it to you again for those who are joining in late. And in any case, they are flashing by for you. Manufacturing is the strongest at 7.4%. Electricity is done reasonably well at 9.2. I'll read again. Agriculture, 3.8% over 2.6 year ago. Construction 7.8 versus 3.1 year ago. Trade hotel 6.8 versus 8.5 year ago. So it was a high base and therefore just 6.8. Services not picking up so much. Finance at 6.3 versus 6.1 year ago. And public administration government work 10.9 versus 6.1 year ago. Upasana?
Yes, Lata, I think clearly the numbers are quite disappointing across the board, I would say. My numbers were significantly higher than these. So I would say largely construction, like Mr. Joshi pointed out, construction, public administration and electricity were known to be buoyant, and that has been the case. However, I think, services, if we actually compare it to the high frequency data that we have been getting for at least the September quarter, we were not really seeing that kind of a slag. And unfortunately, we have seen a significant slowdown in the numbers. So I'm even more worried in what lies ahead, because these were the numbers probably what we were expecting in the next quarter. And if already we've seen these kind of numbers right now, I would be watchful on how the next 2 quarters numbers would be. And the last quarter probably will be lower than 6.5%.
Okay, I don't know if I'm calculating this right, but it looks like a fairly decent capital formation number. I think it's coming in at 12%. Just give me a moment to give you the exact number, but it does look like capital formation is very good. Yes, capital formation is risen by 12.5%. Government final consumption expenditure also up 12.7%. And private final consumption expenditure up only 6.9. I guess exports would have not been all that good. I'll come back with that number. But Soumya, from what you have heard, if you can tell us, what have you made of the numbers?
See, actually, I think we calculated the core GVA part, which is basically an index of the excluding the agriculture and the public sector, the private part, and that has actually significantly slowed down to 6.6%. So that means from 8.1% in Q1, it has down to 6.6%. So I think there is a slowdown which is across the board. And the other important thing is that, as you mentioned, that there was a base effect involved, and our estimation shows that the base effect could be as much as 30 basis points. So if you strip out that 30 basis point base effect, the growth rate has actually dropped to below 7% in Q2. So that's a little bit disappointing. And given the fact that if I try to just reconcile with the series, the backdated series which has been released I think 2 days back. I think now I think now a 7% growth rate looks a little bit difficult in the next 2 quarters, and possibly the growth could be well below 7%.
Okay, then what is your estimate for the full year in that case? We have an 8.1%, 8% GDP for the first quarter. Second quarter, we have 7.1. If you are expecting less than 7%, will we make it to 7 for the full year?
No, I think for the full year, our expectations were GVA was at 7.3% and GDP was at 7.4%. But I now see a clear downside to that estimates. Now the number could be actually much closer to 7% rather than being closer to 7.5%.
Okay. I'm not sure I'm calculating this correctly, and maybe Soumya, you would be able to do it by the time I get to the others. I think the private final consumption expenditure has come at 6.9% higher, and it is at 11-12 prices. And then the government final consumption expenditure is coming at about 12.7% higher, while gross fixed capital formation has come in at 12.5% higher. Exports look very good, actually. They look about 16% higher to me. But I'll wait for you all to process those numbers. Mr. Joshi, what have you made of the expenditure side, and any other comments on how you would look at the second half, considering that the second quarter has fallen short of your expectation?
Yeah, I think if you look at the expenditure side, the only one segment that has driven the growth down is the private final consumption expenditure, and that is the bulk of expenditure side GDP. Rest, all the four, I mean, the whether it is investment or government consumption, they have actually grown faster than the last quarter. So it's the private consumption which I think which was extremely buoyant in the first quarter has slowed down to somewhere close to 7%. So that is one. So now, this being an election year, I think we could see private consumption again go up. So I would not be very pessimistic on the consumption private consumption side, and I would still see, I think, in the second half the growth could be, I think, touching 7%. So that would give you a growth somewhere between 7 to 7.5%. Our current forecast is 7.4%. There is definitely some downside to that number.
Okay, a little lower than 7.4, and Soumya also says his was 7.5, and it's likely closer to 7%. Okay, I revised the numbers. I rechecked the numbers, and it is private final consumption expenditure 6.9, government final consumption expenditure 12.7, and gross fixed capital formation at 12.4. Exports, I think, is around 16%. That's how they stack up from the expenditure side. Upasana, any further thoughts from all the numbers that you have heard?
Yeah, the good thing is that at least gross final consumption is capital is actually doing quite well, and it has continued to grow well. So yes, gross capital formation has been doing pretty well, and that is at least a positive news from all of this, I would say. Exports, I'm not exactly sure, because we know that the second quarter export growth was not as robust. So we'll have to see exactly how we're getting a 16% reading here. But of course, if we exclude that side, then I would be again agreeing with Dr. Joshi that the private consumption could get a little bit of fillip towards the end of FY19, running into the first quarter of FY20, and that is where we could get a support. But having said that, I think I would be worried on the second half of this year's growth, and overall we have an estimate of 7.3% GDP, which could possibly see a little bit of downside.
Okay. Soumya, let's get back to the output side, because I think that is the more reliable number. We are always told that the expenditure numbers are derived numbers, and so we should go forth more with the output numbers. What has disappointed you within the output space itself? Is it construction, as Mr. Joshi was speaking about? One would have thought it would do even better than 7.8. Is it more trade, which has come in actually lower at 6.8? That's usually the robust side of the economy. Is it services that has let the GDP down?
No, I think if you look into the service sector numbers, both the trade segment and the finance segment, I think the growth rates for it, specifically of the finance segment, has been consistently hovering around the 6 to 6.5% mark. In fact, the growth rate this quarter is 6.3%, and which is not much difference from the earlier 2 quarters. And the same thing with the trade and hotels, that is growing at sub 7%. So I think and the only segment which is firing in the public administration, defense and other services, I am not sure how this segment is going to look in the second half, because there are constraints on the fiscal side. To the fiscal deficit numbers which has been released show that even though it's only for 6 months, the number has been overshot. So there is a constant over there. So in the second half, this number is also going to slow down. And if we are stuck in the 6 to 6.5% for these 2 sub-segments which I mentioned, I think this will be very difficult to grow beyond 7% in the second half. And as you have all seen, that the performance of the tertiary sector has been scaled down significantly even in the years prior to 2011. So if I go by that logic, I don't see that the service sector expanding at a frantic rate as we were witnessing earlier, and that could be one of the disappointing things which looks to me from this number, apart from the fact that the rural side is also not growing, even though the agricultural number is not significantly different from the market expectations.
Actually, agriculture number is good, isn't it, at 3.8%? And I mean, I'm just trying to see whether we can pick up some optimism from here. The capital formation is at 12.7%. And we know when we looked at the results of L&T, Cummins, Alstom, ABB, all the capital goods numbers were very good. Their order books were good. And here you're saying capital formation is at 12.4% or thereabouts. Soumya, should we actually prepare for some bit, I mean, I'm not calling it private capex firing, but some bit of a positive from all those?
No, the investment revival is definitely a positive news, but my sense is that given the leads and lags in the investment cycle and the output, the impact on the output, I am not seeing too much into an impact on the output on an immediate basis. Obviously, the investment cycle which has picked up will have an impact on the output at a later date, but to look at it immediately in the current quarter, in Q3 and at least in Q3, looks a little bit difficult for me at this point to believe.
You know, there are some reasons why we may do well in the next quarter. You know, the third quarter last year did pathetically when it came to, trade hotels and in finance. No, I think I'm reading the year ago. I'm sorry. Okay, let me come to you, Upasana. Now that you have had a little more time to process the numbers, do you think that either capital formation or a pickup in public expenditure, a pickup in private consumption, since one normally sees better consumption in the post-harvest period in the second half as well because of elections, do you see both capital formation and consumption maybe giving us a better than expected second half?
Lata, I think there are 2 parts to this. While yes, agreed, post-harvest and election are 2 factors which could be supporting growth. We are seeing that in general we've been seeing very muted rural wages. That is something which hopefully it might improve as we go ahead. But as of now, at least whatever data is available, it's not showing any positive signs there. Urban demand also seems to be quite static, so to say. So here, important point is that while yes, there are tentative signs or early signs of improvement in investment growth, but as we go ahead, the improvement will sustain only when there is clear visibility of robust demand. And if we are seeing some kind of a slowdown there, then the possibility is that we might see somewhere the investment growth fizzle off again. So whether it is sustainable is going to be a function of how robust and how sustainable is a strong consumption demand, and that somewhere we are seeing some kind of a stagnation, if not a deceleration, and that's where my worry is. So while yes, today we do see a strong investment growth, But will this sustain is a function of how exactly we can sustain through the consumption demand. And of course, we should not forget the recent issues that are surrounding the banking system and the financial sector. That too will somewhere have a bearing on growth. So second half of the year, again and again, that's why I mentioned that I'm a little wary. And to average 7%, it's going to be a tall task.
Okay. All right. Now that's looking a little difficult to get to 7%. What are you working with for the full year at the moment, now that you know the second quarter? I know it's going to be rough and ready figures, but Soumya said 7.5, but he expects it would come closer to 7 at this point in time. I guess he'll work out his figures. Mr. Joshi was working with 7.4. He expects it would have a downside risk. What's your number?
Yeah, so 7.3 is what we were working with, but with a higher Q2 number. Now, I think there is a slight downside to this. We could be anywhere between 7.1 to 7.2 GDP numbers.
Okay. All right. Difficult. But, let me just put another spin. We are also having the advantages of a lower crude price and, a stronger rupee. So that's going to have some advantages for some sectors at least. I mean, logically, you should see higher margins for a lot of corporates. And, the government, after having cut the excise because crude prices went up, fuel excise, has not pushed it back. So there is a little bit of that money also which comes to the consumer's pocket. Disposable income should be therefore a little more, since people are going to spend less on petrol and diesel. Don't these little bit also add to consumption? Additionally, of course, good harvest and government election spending. Will all these add up to something at all, Soumya?
No, I think that's a fair point. And if you actually look into the discretionary spending for the consumers, specifically in the rural areas, they had actually slowed down significantly in the month of September when the fuel prices, and to some amount in October also, when the fuel prices actually used to touch new highs. But with the meltdown in the oil prices, I think there will be some rebound in the consumption, and that was some part of that was felt in the Diwali week when there was a strong surge in the currency in demand. But the interesting part is that after the Diwali week, the currency increase have actually moderated. It has in fact declined from the levels which we witnessed that time. So I am not sure how far this consumption boom will be sustained, but there will be some impact on consumption. But again, as I said, that works with a lead and lag relationship. So an impact on the output growth at this point of time looks a little difficult, at least in the current fiscal.
Okay. Well, let me look at the causes and see, Mr. Joshi, what would you identify as the causes? Why this disappointment? We've had a fairly decent base, 6.3. We had decent corporate results as well, especially like we told you in companies like L&T, the investment sector. I don't remember any of the consumer companies really disappointing. All the Hindustan Levers and the Maricos and the FMCG paint companies, all of them reported reasonable volumes. It was only automobiles that started slowing, and even that was October when the festival sales didn't fire up. What has gone so wrong in the second quarter?
Well, I think if you look at the numbers, I think I agree with you that the top line has been quite buoyant, but the bottom line, because of increased input costs, the oil prices were high, so that the bottom line hasn't grown that much. And GDP is more closely related to bottom line than to the top line. So I think that's what is getting reflected in the numbers. And as far as interest rates are concerned, I think whatever little impact they had, I think they have only moved on the upper side. I mean, they haven't declined. So that also has a lagged impact, but I think that's also one of the factors which is going to play out.
Oh, yes. Interest rates, I would assume, at least wholesale rates have fallen distinctly, now at 7.6, and could fall further, considering that I think they're heading for an inflation number which will be even below 3%, at least for 1 month. Soumya, final thoughts from all three of you. I want a base case and a worst case. If you can give me a best case also. GDP numbers for the full year. Soumya? Base case?
As of now, I have to rework the number, but I think the GDP number in the best case for the year could be around 7.2, and the worst case could be maybe around 6.8 to 6.9.
Okay. Upasana?
So not much difference from last year.
Sure. Upasana?
Yes, Lata, I would agree with Soumya. I think 6.8 to 7.2 is a good enough range on the bottom and the top.
Okay. Mr. Joshi?
Yeah, our baseline is 7.4. There is no upside to this because the global risks are rising, and I think there's only downside, and the downside we have to work out. I mean, I can't just give it from the top of my head right now.
Okay, all right, Upasana, Soumya, and Mr. Joshi, thank you very much for joining me with your instant analysis of the GDP numbers. The numbers are not looking all that encouraging. We had a good base to start with. Year ago, it was only 6.3. So to do better and come above 7% or 7.5% was not very difficult. Our own poll was expecting 7.4, but what we have is only a 7.1% second quarter GDP, and of course GVA not even making it to the 7% mark. A little troubled by the early consumption trends and the fiscal deficit for the second half. It looks like both government final consumption expenditure and consumption, private consumption, cannot really fire up so much for the second half. So we could be actually staring at a sub 7 for this year, but with some luck, maybe just north of 7, not a very great number. Thank you for watching this special show on the state of the economy and the second quarter GDP numbers. To stay on, there's lots more on CNBC TV18.